Hi everyone, welcome back to part 3 and the final part of my HireQuest analysis. I hope you're enjoying this video series so far. It's a very interesting company. Today I'm going to go through, I think a competitive analysis is going to be really important, a big risk around that competitive analysis, and then we're going to jump into the valuation finally and summarize this whole thing up. So this will be the last video on this one. I hope you're enjoying it. There's a link in the description to Interactive Brokers if you haven't got a broker yet. I highly recommend. There's videos here in the channel about taking you through how it looks and how it works if you need some help with that. I have multiple brokerage accounts. Interactive Brokers I think is the best one. Yeah, link in the description for that. Let's jump into this competitive analysis of HireQuest. And there's two big players in this market. One is called Manpower, and they're about 10, 15 times the size of HireQuest at the moment based on a market cap. They're a public company too. But when analyzing the financials of Manpower, their margins are awful. About 3% operating margins, about 1.5% net income margins. This isn't a franchise business, so it's not the same. They are running this tough staffing business on a large scale from the head office. It's tough. This is a difficult business that they're trying to do. But they do have long relationships with large clients. There is a market for both, I think, the smaller franchise model of HireQuest and a big company like Manpower. But HireQuest have this acquisition engine available to them because they're so profitable, whereas Manpower will always find it difficult to grow like HireQuest. So I would consider Manpower this like clunky, big, slow-moving powerhouse in the space, and HireQuest is the more agile, faster-moving growth business in the space. But size does matter a little bit in this industry because they can pull big contracts. So that is something that Manpower will have an advantage over for HireQuest for some significant amount of time. But I do think the franchise model of HireQuest is just a far superior way to do this, rather than any sort of roll-up strategy that Manpower can do that don't roll down the responsibility back down to the franchise level. Then the next big player in the space is HODDE'S, and they're actually a European company based out of Switzerland. They're about 20 times the size of HireQuest, or they're even bigger than Manpower. Margins are similar to Manpower. They've got obviously better relationships with Europe, and they're the big player in that market. They're making acquisitions as well and rolling up the space over there, but it isn't the franchise model, and those margins are poor like Manpower. They're not going to be agile like HireQuest is. The key to HireQuest is that the decisions are made at the ground level, closest to the action, and that is the big benefit here. And HODDE'S do not do that. Don't have that model as well. They're just a roll-up big corporation similar to Manpower. Now, the big risk out of this entire thing, I think, is if Manpower or HODDE'S were to switch to a franchise model because they see it as the better model, and they start to essentially copy HireQuest. It would be very possible that they do this, but I also think it would be unlikely, as that would be turning around and reorganizing this multi-billion-dollar company. The culture, the bureaucracy, that would be a tough thing to change in this sort of legacy business. But it is possible. It would require a really strong leader to come into one of those businesses and shake things up. But it is very possible, and they have good relationships, so they could pull it off. And that would be a risk for HireQuest because all of a sudden they would have a competitor who's lean and mean like them. Okay, I think we're there. I think we're finally ready for evaluation. So let me jump into my computer and I will go through a few different scenarios. Now, the first scenario I want to go through is, well, there's obviously a chance of fraud here. I'm going to say that's very low considering we're getting a dividend, the track record, it's in America, all those types of things. I'm going to say there's a 1% chance that we're getting lied to. And then if this was to, let's say macroeconomic conditions were tough, really tough for the next few years, and we essentially get no more growth from here, even though it's been growing rapidly, they're making acquisitions, all these things. This would be a pretty dire situation. I would say this is as low as a outcome as we could get, would be 0% growth over the next 5 years. I guess it could decline, but the fact that they're sitting on plenty of cash, they're making plenty of money, they've got these reliable revenues coming in, it would be tough to see them declining, but it could happen. Franchisees could be leaving, but let's just say there's a balance between the two for the next 5 years, and we're going to have 0% growth, a free cash flow multiple on that of only like 10. And we're looking at a share price in 5 years of about $12. That's essentially half the share price what it is today, roughly. So I'm going to say there's a 5% chance of that happening. I don't think it's likely. I think it's more likely that we see something like this happen, where we've got 10% growth, a better multiple of around about 15, and we're going to look like we're going to get about a 1.5 times our return on our money in the next 5 years at a share price of about $20. And I'm going to say there's a 34% chance of that happening. The reason it's 34, not 35, is just because of the 1% up here. Then there's another scenario where I think it's probably a little bit more likely again, where we get more like 15% growth. Remember, it's been growing at 40% for the last few years. This would essentially saying that we're still having a downturn, but it's just not as dramatic as I was saying earlier. The multiple can be a bit higher with that higher growth rate. And now we're talking about a double in this. And I say this is probably the more likely scenario at 40%. But then there's still a reasonable chance that we get 20% growth for the next 5 years. Even though it could be higher, I'm just going to temper that a little bit and say 20%. That's still very strong growth. A higher multiple because it's a franchise model. It's got very good revenues. People finally realize that this is a great business. And now we're talking about a 3.5x return on that. I'm saying there's a 20% chance of that happening, which is strong. I feel pretty comfortable with these percentage likelihood outcomes, and an expected return at about $20 a share, in my opinion, is about a double. I should expect about 2x with all those different scenarios, and that's sort of how I've worked that out. As you can see underneath, I did at about $15 per share, which would be a market cap of $225. If I do run those through those same numbers again, we have a little bit higher. So if I start at the bottom this time at 20% growth rate, 25% cash, 25% multiple, we're looking at a 35% CAGR, which is a 5x from $15. And I've done the same calculations here with all the other scenarios, just like I did in the first case. And now we're looking at an expected return of closer to 3x. So paying $15 a share feels far more beneficial from a return point of view than paying $20 a share. Makes sense. That's pretty logical. And I'm feeling good about my expectations about this business. And that's maybe I'm being a little bit too conservative. That's for you to decide based on your analysis. But this is sort of how I'm thinking about the business. I think this is a good ballpark to start. And then I go over and look at like a DCF out over 10 years, so a little bit longer time frame. And my growth rate's sort of what I was thinking about, around about the middle of my ballpark here. So I've got 15% and then 12%. I'm chasing a 22% discount rate, the multiple, operating cash, shares outstanding, and that's shares outstanding in 10 years' time with a 1% dilution rate, by the way, just so you know. I know it's about 13 at the moment, so I'm assuming a little bit of dilution. And we're saying we do want to buy this around about that 15, 16 mark. If the growth rate was to be stronger, or maybe I wanted a better, let's do a better discount rate first. I prefer 26%. We want to pay about $12, but I could be wrong, easily be wrong with those growth rates. And we're still looking at probably $15, $16 here. This seems to be the right number for me to get comfortable with this. I think I've built in a fair bit of margin of safety there. I don't think I'm being overly conservative. I don't think I'm being overly aggressive. I'm feeling this is about right. And this is how I do a lot of my valuations. It's feel, it's art, it's not science. It's playing around with the numbers. Which one feels more comfortable? Which one feels a bit on the risky side? Which one makes me feel a bit uncomfortable? And that's how I do it. So these are things I like about the business. They've got strong return on invested capital. There's a long runway for them to grow into and a high growth rate potential as well. They've got low debt and they're using cash, all of their cash, to make acquisitions. It's a great franchise model in a tough, boring industry. And I love the decentralization of that model. And in turning to the things that I don't like about the business, well, I haven't interviewed management yet, but I want to, but I haven't done it. I am nervous about it being a bit boom time earnings. I guess that's why in my valuations, I was quite happy to really pull that back a lot. The big thing I don't like about this business, it is still fundamentally in a tough industry. If there is poorly run franchises, which there will be, they will get shown, and it'll be easier for other potential franchisees to see that some of these franchises failed, and that could make it really hard to sell to other franchisees in the future. I don't know. being in a tough industry, you just don't get that like general tailwind. I guess you get the general tailwind of staff wages increasing with inflation, but besides that, this is a tough game to be playing. And there are some big competitors in the space that could go down that same path, even though I think it's unlikely. But really, I'm pulling at straws here to find things that I don't like about this business. A lot of it is really exceptional. So I hope this was interesting to you. A big thank you to Aaron Edelhart from Mindset Value. I'll leave a link in the description below to his write-up. It was done a few years ago. And also to Jamie Bermejo, sorry for the mispronunciation, for their work on this as well. There's a link in the description to that too. I hope you've enjoyed all of this. I hope this is a great starting point for you to do your own digging into HireQuest. Tell me what you think. Pull this one apart for me. Criticize it. Do whatever you can. I need to hear what you think, because that's why I do these videos, is for the community and the ideas and the criticism and the feedback and all that stuff. That really helps me make better decisions. So please, I encourage you to do that. Subscribe if you haven't done it yet, because I hopefully will be providing you some value, and I will see you in the next video.